Welcome back in, ladies and gentlemen. So this is a big week here. This is a big setup, I believe, for the charts. What do we have going on today? Well, so on Friday, October 4th, we are waiting for some data to drop here. We're going to react live to it. U.S. non-farm payrolls meeting expecting to come in around 150,000. Unemployment rate expected to stay flat at 4.2%. This is going to be a big one here. I'm going to talk through why it's almost a lose-lose situation here. So that's going to be an interesting one to watch react. U.S. hourly wages is expected to come in at 0.3%, and hourly wages year over year expected to come in 3.8%. So let's get to the news here and see if they're going to drop any minute here. At the top right-hand corner, we do have the S&P 500 futures, which are up. And so we're going to wait for this news to drop, watch it live, and see what the market does. So the upper right-hand corner is going to be market reaction. And then I'm going to give my 2 cents and figure out what the charts are telling us.
We are a minute and a half away now from the government's employment report, ahead of the numbers.
Well, I think we're going to be higher than expected. So I think, I'm looking for the over on jobs, and I think the actual unemployment rate, if it moves higher, that'll be a big deal. If it stays the same or moves lower. But I think that the actual jobs number is going to come in better than expected. That's what I would think would be the surprise today. But this number is truly, we say it almost every month, and maybe it's true every month, but this particular jobs number, I'd like to see if Steve agrees, is really going to have an outsized potential effect on the marketplace and investor psyches, because we've seen the Fed now flip their lens to the labor market. Here, 2 seconds away, and as we come, hitting the wires on the September jobs report, the over wins 254,000, significantly better than 150 expected, and an upward revision to last month from 142,000 to 159,000, which means the 2-month revision now is a little over 70,000. If we look at the unemployment rate, it is at 4.1. 4.1, it moved lower. I can hear yields moving higher as we speak. And 4.1, of course, equals where we were in June. You have to go to May to get a lower number at 4%. Average hourly earnings month over month, better than expected, up 0.4%, which equals where we have been in May. You have to go back to the beginning of the year, January, when we were up 0.5%. Now, if we look at average hourly earnings on a year-over-year basis, this number also much better than expected. 4%. That are big, smart reversals. Today now marks the 3rd consecutive session that Treasury yields have climbed over the previous day's high yield, or if you want to look at it in terms of low prices.
Well, interesting take overall when we think about this hurricane hitting. And I can tell you guys, living in Florida, thank God I live in Central Florida, we were completely fine. But I will say that the hurricanes have done way more damage than I even anticipated. This is one of the worst hurricanes as far as damage done that I've seen in my area that I've lived in, close to the Clearwater Beach area, is completely demolished, which is going to impact the labor markets. A few different things I want to talk through here. Number one, let's take a quick look at the chart. We're getting an explosion up in stocks, but the one thing I want to talk about here is the conundrum that the Feds are in right now. Now, they lowered rates, which actually might cause more inflation because the labor market is much stronger than they anticipated. They obviously don't have any extra data that we don't have, and so they might have been a little premature here with the rate cuts. There's no question that this labor market is definitely way stronger than I anticipated, but what was one of the things that they said? Healthcare and hospitality and government jobs have kind of been carrying this labor market. Now, the one thing I hate about hospitality carrying the labor market is going to be the fact that the minute that the consumer stops spending, hospitality is going to fall by the hip side. This is not sustainable labor market growth. Because the consumer has a lot of money to spend, that is holding up the labor side of the economy. This is going to come down to today's close, ladies and gentlemen. Do not get excited about the initial pop. If this continues, then that is going to be a bullish indicator, as that'll unravel the MACD rolling over. and that'll start pointing to possibly us hitting this trend line once again and getting closer to 577, which it would be basically a full percentage point move up, in my opinion, before we start hitting some resistance. But what I want to point out is the 10-year treasury is starting to move up, and that should put downward pressure on stocks. This could also be inflationary data coming in, and I don't think the market is looking at this as being inflationary data. We look at wage growth and we look at how many jobs are still out there. But once again, I want you guys to stay focused on valuation. I want you to stay focused on the 10-year treasury that's actually spiking. So we're watching the 10-year treasury go up, and we're watching stocks actually rebound on this news. Knee-jerk reaction is nothing is bad. This is looking like a Goldilocks situation, which is 100% right. But at what point do we have to look at valuations, guys? At what point is it going to matter that we have a 10-year treasury pushing now above 4%, which nobody thought was going to happen here? Nobody thought the 10-year treasury was going to push above 4%, but take a look. We talked about the reverse head and shoulders playing out here. That is absolutely taking place. Eventually, if this 10-year breaks above this 4% mark, that's where we're going to start seeing pressure put down on the stock market. So knee-jerk reaction on stocks is the market's going up on this good news, Goldilocks situation, economy is much more stronger. But the whole reason why the market's going up is because the Feds were cutting rates. So there is a conundrum here that is just not making sense to me. And so the only thing I stay focused on is where are real rates and where are valuations. And when we look at real rates versus valuations, with the 10-year going up now and the expensive stock market going even higher, there is a case now for the 10-year treasury to be a place to hide. And it's also causing the 2-year to stay pretty elevated here, which is going to force that money market money to stay in accounts. When we look at the market now up roughly 1% across the board, as I stated, the close is going to be extremely important today. If the close ends up being in a positive territory and we unwind the MACD rolling over, then the correction phase is going to be extended towards the end of October, in my opinion. But if we see this as a knee-jerk reaction and a sell-off continuing throughout the day with that MACD rolling over, I still believe that we are in a correction phase heading into next week. So just to kind of give you guys the breakdown here, markets stay elevated today and we end up in positive territory about 1% or higher, then I do think that it's going to unwind the MACD and we're looking at possibly a correction phase coming later into the October. If we see the market sell off today, and indicators are starting to point down and MACD starting to roll over, then the path of least resistance is going to be a correction phase heading into next week and into the end of October, in my opinion. So as of right now, I still think it's a great opportunity on these big rips to take profits. When we look at where valuation is, we're talking about on today's open, we're going to be pushing 29 times earnings. We look at 29 times earnings, but we're also now looking at a 10-year treasury that's starting to peak above 4%, that could start peaking above 4% as the day progresses, which now lets us put in line where we're looking at when we look at valuations. So we have a 29 PE ratio on the S&P 500, and just for simple math, let's just say we're looking at a 4% yield. We have a 25 PE ratio on the 10-year treasury. And so once that 10-year treasury starts breaking above 4%, ladies and gentlemen, this is where the 10-year treasury is getting competitive, where we're looking at the S&P 500. So I do think there's an argument as markets go higher and the 10-year goes higher that it makes sense to possibly be looking at the 10-year on a break above 4%. I think trading at 29 times earnings is pretty ridiculous right now, but there's nothing that's really derailing the labor markets, and that's making the stock market excited. But the problem is when we look underneath, the 2-year and 10-year are now starting to be once again competitive to where valuations lie. So wanted to kind of break this down. Hopefully you guys enjoyed my live breakdown, and as always, really appreciate your time. Thank you guys so much for spending it with me.